You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the Deep Dive. Today, we're getting into something really interesting in personal finance. It's this paradox, right?
Yeah.
Markets go up over time, but so many people feel kind of lost or intimidated, maybe left behind when it comes to building wealth.
Yeah, it's a real issue.
So our deep dive today is into index funds. Now, this strategy, it sounds almost too simple, maybe even boring. But it's quietly made more millionaires than, well, almost any other approach out there.
That's exactly right.
We're going to show you how this supposedly boring way to invest could actually be your most powerful tool.
Definitely. Our mission today really is to just break down index funds, take away the mystery. We'll talk about what they are, how they actually work to build wealth, sometimes quite significantly, and, the important part, the practical steps you can actually take.
Right. How to use them.
Exactly. How you can use them to get started or maybe optimize what you're already doing. We'll also clear up some common myths, share some real-world examples that are pretty compelling. So yeah, if you're looking for a path, a straightforward, proven path to long-term growth, this deep dive should be really valuable for you.
Okay, let's unpack that.
Yeah.
What are index funds exactly? Because, for a lot of folks, it just sounds like more Wall Street jargon.
It does. It can sound that way.
But really, at its core, an index fund is just a type of investment fund. Could be a mutual fund, could be an ETF, an exchange-traded fund. And it's designed simply to track the performance of a specific market index.
Like the S&P 500.
Exactly. Like the S&P 500. Everyone knows that one, right?
Sure.
500 biggest U.S. companies. So an S&P 500 index fund just tries to match that performance. Think of it like this, maybe. Instead of you trying to pick the winning stocks, which is, let's face it, incredibly hard.
Very hard.
An index fund basically buys you a tiny piece of every company in that index. So you invest in an S&P 500 fund, you're getting a little slice of Apple, Microsoft, Amazon, Google, plus 496 others, all in one go.
And that simple idea, it sounds so straightforward now, but it was genuinely revolutionary back when John Bogle launched the first one for regular investors at Vanguard in 1976.
Really? What was it like before then?
Well, before index funds, your main choices were, 1, trying to pick stocks yourself, which honestly takes a ton of research. It's risky, even for the pros.
Right.
Or 2, you put your money in actively managed mutual funds. That's where you pay a professional manager or a team to try and beat the market, pick the best stocks, time the trades, that sort of thing.
Okay, that sounds reasonable. Pay someone to do better.
Yeah, but here's the kind of dirty secret of active investing. Those funds often have pretty high fees. And surprisingly, study after study shows most of them don't actually beat the market average once you account for those fees.
So you're paying more for often worse results.
That's often the case, yeah. Index funds solved this really elegantly. They just said, look, forget beating the market, let's just match it. And because they don't need those expensive managers doing research and trading all the time.
The fees are super low.
Exactly. Incredibly low fees. That simplicity and efficiency, that's the magic.
So the genius is really in not trying to be smarter than everyone else. It still feels a bit counterintuitive. All the focus is usually on beating the market.
It does feel that way, but yeah. By not trying to pick winners, they avoid all those costs, research trading, even the human biases that managers fall prey to. They just mirror the market's overall journey. And the low fees mean more of the market's return ends up in your pocket, not the fund managers.
Okay, this is where it starts getting really powerful, isn't it? The financial superpowers behind index funds. You mentioned 3 things. Compound interest, cost efficiency, and market participation. Let's start with compounding.
Yes. Einstein supposedly called it the 8th wonder of the world.
Right. And maybe he did, maybe he didn't. But the concept itself, it's not just earning returns on your original money.
No, it's earning returns on your returns. And then returns on those returns. It creates the snowball effect. It starts slow, but then it just picks up speed. It grows exponentially over time, especially if you reinvest the dividends.
Can you give us a sense of what that snowball looks like in actual dollars for someone listening?
Okay, yeah, let's make it concrete. Imagine you start investing, say, $500 a month. You put it in an S&P 500 index fund starting at age 25. And let's assume you get that historical average return, around 10% per year.
Okay.
By the time you hit 65, that's 40 years later, you would put in $240,000 of your own money. $500 times 12 months times 40 years.
Right. Makes sense.
But your account, it wouldn't be worth $240,000. It would be worth roughly $1.4 million.
Wow. So over $1 million is just growth.
That's the compounding.
Yeah.
$1.16 million generated by your money working for you over those 40 years. But here's the really striking part. What if you wait?
Okay.
What if you wait just 10 years, start the same $500 a month investment, but at age 35 instead of 25?
All right. Same investment, just starting later.
By age 65, you'd end up with only about $540,000.
That's less than half.
Exactly. Starting just 10 years earlier more than doubled your final result. And you only invested an extra $60,000 of your own money in those first 10 years. $500 by 12 months by 10 years.
That's incredible. Time really is the secret ingredient then.
It's absolutely crucial. The earlier you start, the more powerful compounding becomes.
Okay, so compounding is huge. What's the next big advantage? You mentioned cost efficiency. The fees.
Right. And this ties back to that active versus passive thing. Those actively managed funds, they often charge around 1% per year, sometimes more.
1% doesn't sound like a lot, though.
It doesn't, does it? But let's run the numbers again. Imagine you have $100,000 invested. Over 30 years, that seemingly small 1% fee could actually cost you around $200,000 in lost growth compared to having no fee.
$200,000
Yeah.
just from a 1% fee.
Yeah, because it's not just the fee itself, it's the growth you lose on the money you paid in fees. It compounds against you. Now compare that to index funds. Their fees or expense ratios are typically tiny, like 0.03% to maybe 0.20% per year.
So like pennies on the dollar compared to active funds.
Exactly. It's a massive difference, and that difference stays in your account, compounding for you year after year.
Okay, compounding, low costs. What was the third one? Market participation.
Right. This is simpler, but just as important. When you own a broad market index fund, you're essentially owning a piece of the entire economy, or a huge chunk of it.
Right.
You're betting on overall economic growth, on human ingenuity, innovation, companies growing.
They're betting on progress, basically.
Precisely. And historically, despite all the ups and downs, the stock market has trended upwards over the long term because economies grow, companies create value. So owning the whole market through an index fund has proven to be a very, very good bet over time.
Okay, that makes sense. So let's talk track record. You mentioned the S&P 500 historical average is about 10%. How reliable is that, given all the craziness the world throws at us?
It's actually pretty remarkable when you look at the long view. That roughly 10% average annual return for the S&P 500 goes back something like 90 years. And think about what happened during that time.
Yeah, like the Great Depression, World War II.
Exactly. The Great Depression, WWII, the Cold War, multiple recessions, the oil shocks in the 70s, the dot-com bust, the 2008 financial crisis, the recent pandemic.
It includes all of that.
All of it.
Right.
The average includes the absolute worst days, the crashes, everything. And here's something even more striking. Even if you had incredibly bad luck, say you invested a lump sum right at the market peak just before the massive 1929 crash.
Oh, wow. The worst timing imaginable.
Pretty much. If you just held on through the downturn and beyond, reinvested dividends, you still would have come out ahead over the long term. The market eventually recovered and went much, much higher.
That resilience is amazing. Which really begs the question then. If the market does so well long term, and index funds make it easy to capture that return, why don't more people build serious wealth this way? What are the traps?
That's the multi-million-dollar question, isn't it?
Yeah, because despite this great tool, a lot of people struggle. The one big reason is just complexity or perceived complexity.
Right. Investing feels complicated.
Yeah, the financial news makes it sound like you need complex strategies, you need to watch the market constantly, it's overwhelming. But index funds, they cut right through that. The strategy is dead simple. Buy and hold. You don't need to analyze charts or read earnings reports.
Takes the complexity right out.
Another trap. The myth that you need a lot of money to start. We hear that all the time.
Yeah. I'll invest when I have more money.
Exactly. But with index funds, most have no minimum investment amount anymore. And lots of brokers let you buy fractional shares. So you can literally start with like $1. So that excuse is gone.
Totally gone.
Then there's choice paralysis. You log into a brokerage. There are thousands of stocks, ETFs, mutual funds. Where do you even begin?
It's overwhelming.
But again, index funds simplify it. For most people starting out, honestly, just picking one fund like a total U.S. stock market index fund or an S&P 500 index fund is totally sufficient. You don't need a complicated portfolio.
Keep it simple.
And then there are the big behavioral mistakes, right? Trying to time the market, guess when to get in and out, or trying to pick the next hot stock.
Which almost never works consistently.
Right. Index funds just remove that whole temptation.
Right.
You buy the whole market, you hold it, done. And finally, back to those fees. High fees just silently sabotage your returns over decades. Index funds solve that with their ultra-low costs.
And building on those behavioral mistakes, there's a huge psychological advantage to index funds too. It's maybe less obvious, but really important.
How so?
Well, investing can be an emotional roller coaster, right? Fear and greed drive a lot of bad decisions. If you own individual stocks, every news headline about that company, good or bad, feels personal. It can make you panic sell or chase performance.
Yeah, I can see that. Your fortunes feel tied to one or two companies.
Exactly. But with a broad index fund, you own hundreds, maybe thousands of companies. You're insulated from that single company drama. One company having a bad year doesn't sink your whole portfolio. This makes it psychologically easier to just stay invested, especially when the market gets choppy.
Less temptation to react emotionally.
Precisely. It also dampens that urge a lot of people have to constantly tinker with their investments. Sell stocks that have gone up, hold on to losers, hoping they'll recover, jump into whatever's hot this month.
All the things experts tell you not to do.
Right. And most crucially, it helps you avoid the single biggest mistake investors make, trying to time the market. There's this famous research by a company called Delbar.
Oh yeah, I've seen that. It's pretty sobering.
It really is. They track actual investor returns versus market returns, and consistently they find huge gaps. For example, over a recent 20-year period, the S&P 500 returned about 10% per year, but the average stock fund investor, they only earned about 4.25% per year.
Wow. Less than half the market return. Why?
Mostly because of bad timing. Jumping in and out of the market based on emotion, getting scared during downturns and selling low, getting greedy during rallies and buying high. Index funds, by encouraging that buy and hold approach, help you avoid that self-destructive behavior.
Okay, that Delbar stat really drives home the behavioral side. Let's make this even more real with some millionaire math.
Yeah.
Show how this actually plays out for different people. Because it's not about massive salaries, right?
Not at all. It's about consistency and time.
Okay, scenario one, Sarah. She's a recent graduate, maybe 22 years old, got student loans, but manages to scrape together $200 a month to invest in a total stock market index fund. Just $200.
Okay. Seems doable for many.
If she does that consistently until she's 65, assuming average market returns, that $200 a month grows to over $1.1 million.
Just from $200 a month starting early. Incredible.
Exactly. Shows the power of starting young.
Yeah.
Okay, scenario two, Mike. He's changing careers, starts a bit later, say age 35. He puts in an initial $5,000, then adds $400 per month.
All right, a lump sum plus monthly contributions.
By age 65, Mike would have around $890,000. If he could manage $600 a month instead of $400, he'd likely cross that $1 million mark.
Still very achievable, even starting at 35.
Definitely. Scenario three, Jennifer. She's a late starter, maybe 45. Knows she needs to catch up, so she gets aggressive, invests $1,000 per month.
Okay, bigger contributions later in life.
Even starting at 45, by age 65, she'd have roughly $630,000. Not quite $1 million, but still substantial. If she could push it to $1,500 a month, she'd be closer to $945,000.
Proves it's never truly too late to make a difference, though starting earlier is obviously better.
Absolutely. Last one, David. He inherits $50,000 at age 30, invests it all in index funds, and then adds $300 per month on top of that.
Okay, a windfall plus regular savings.
By age 65, that combination would grow to approximately $1.8 million.
Wow. That inheritance gives a big boost.
It does, but the key takeaway from all these is clear, isn't it?
Yeah.
Becoming a millionaire with index funds isn't some secret Wall Street trick. It's about starting, being consistent, giving it time, and letting that compound interest do the heavy lifting.
Absolutely. So for anyone listening who's thinking, okay, I'm convinced, how do I actually do this? What are the practical steps? It's simpler than you might think.
Let's break it down. Step one.
First, you just need to open an investment account, a brokerage account. You can go with the big established firms like Vanguard, Fidelity, Charles Schwab. They're all great. Or you could use a robo-advisor like Betterment or Wealthfront, which can be super user-friendly.
And opening an account is mostly online now, right? Pretty quick.
Yeah, it usually takes minutes. Fill out some forms online, maybe link your bank account. Step two, choose your index fund.
Okay, the paralysis potential again. How do you choose?
Keep it simple. For most people, especially starting out, one of three options is perfect. One, a total stock market index fund, owns basically every U.S. stock. 2, an S&P 500 index fund owns the 500 largest U.S. companies. Or 3, a target date fund.
What's a target date fund?
It's designed for retirement. You pick the fund with the year closest to when you expect to retire, say target date 2060. It starts out mostly in stocks, like index funds, and automatically gets more conservative, adding bonds as you get closer to that date. It's kind of a set it and forget it option.
Okay, choose the fund. What's next?
Step 3, and this is super important for consistency and avoiding emotional mistakes. Set up automatic investing. Tell your brokerage to automatically pull, say, $200, $500, whatever amount you choose from your bank account every month and invest it into your chosen fund.
Takes the decision-making out of it each month.
Completely. Automate it. Step 4, make sure you reinvest dividends. Most funds pay out small amounts of cash, dividends, from the companies they hold. You want those dividends to automatically buy more shares of the fund.
Compounding the compounding.
Exactly. It turbocharges the growth. Most brokerages have a simple checkbox for this. And finally, step 5, ignore the noise.
Easier said than done sometimes.
It is. The financial news lives on drama, daily ups and downs, predictions. Your job as a long-term index fund investor is to just tune it out. Focus on your plan, keep investing automatically, and let time do its work.
That ignore the noise part is so critical. That urge to do something, especially when markets are volatile, is strong. But the strategy is often do nothing. Just keep investing.
Precisely. Now, we've talked mostly about U.S. funds like the S&P 500. Should people think globally too?
Good point. Does this work internationally?
Absolutely. The same principles apply. You can buy international index funds that own stocks in developed countries outside the U.S. or emerging market index funds. Adding international funds gives you even more diversification.
So you're not just betting on the U.S. economy, but global growth.
Exactly. A common rule of thumb you might hear is maybe a 70% U.S. stock index, 30% international stock index allocation. It lets you participate in growth wherever it happens. You're basically betting on, human civilization continuing to innovate and grow worldwide.
That's a pretty good bet to make long term, I'd say.
Yeah.
Okay, earlier you teased a hidden advantage of index funds, something beyond low costs.
Yes. Tax efficiency. This is especially important if you're investing outside of retirement accounts, like in a regular taxable brokerage account.
How are they tax efficient?
Because index funds buy and hold mostly, they don't do a lot of trading within the fund. Actively managed funds, on the other hand, are often buying and selling stocks, frequently trying to chase returns. All that buying and selling can generate capital gains taxes, which get passed on to you, the investor, each year.
So even if the fund does well, you might owe taxes on its internal trading.
Correct. Index funds, with their low turnover, generally distribute far fewer taxable capital gains. This means more of your money stays invested and compounding year after year. It can add, potentially, an extra 1% or even 2% to your after-tax return compared to a less tax-efficient active fund.
That's another hidden cost of active funds, then. And how does this fit with retirement accounts like 401ks or IRAs?
Well, index funds are fantastic choices inside retirement accounts, too. Those accounts already have huge tax advantages. Your money grows tax-deferred or tax-free. So combining those tax benefits with the ultra-low costs of index funds, it's incredibly powerful.
Especially if your employer offers a 401k match.
Oh, absolutely. Getting that employer match is free money. Putting that free money into low-cost index funds within your 401k, that's like wealth building 101. It's one of the best deals available to most working people.
Okay, so we get to $1 million. What about beyond? Does it get easier?
It actually gets faster, generally speaking. Think about that compounding snowball. When you go from $0 to $1 million, your returns are calculated on a growing but still relatively smaller base. But once you have $1 million, a 10% return adds $100,000 in a year. When you have $2 million, a 10% return adds $200,000.
The returns themselves become much larger amounts.
Exactly. The time it takes to get from $1 million to $2 million is typically much shorter than the time it took to get from $0 to $1 million, assuming consistent returns and contributions. That's why people who stick with index investing long enough don't just become millionaires, they often become multimillionaires just by staying the course.
It's amazing how that math works out. Now, even though it's simple, what are the common mistakes people still make with index funds? Things to avoid.
Yeah, even with a simple strategy, people find ways to mess it up. Number 1, again, is trying to time the market. Waiting for the perfect time to invest or trying to sell before a dip and buy back in, it just doesn't work. Time in the market beats timing the market.
Just get started. Stay invested.
Right. Second big mistake, panicking during market downturns. Markets go down sometimes. It's normal. Selling when things look scary locks in your losses and means you miss the eventual recovery. Smart investors actually see downturns as opportunities.
Opportunities to buy more shares at lower prices, right?
Exactly. Shares are on sale. Third mistake, constantly checking your account balance. Watching the daily fluctuations will just stress you out and tempt you to make emotional decisions. Check maybe once a quarter or even once a year. Focus on the long term.
Put it on autopilot and look away.
Pretty much. Fourth, chasing performance. Picking an index fund just because it did great last year. Past performance doesn't guarantee future results. Stick with broad, low-cost index funds representing the whole market.
Don't chase trends.
And finally, a mistake of omission. Neglecting to increase your contributions over time. As you hopefully earn more money throughout your career, try to bump up that automatic monthly investment. Even small increases can make a huge difference decades down the line.
Great points. So let's try and wrap this all up. What's the core takeaway from this deep dive?
I think the main message is that building significant wealth with index funds isn't about some kind of financial wizardry. It's not magic.
No secret formulas.
No, it's simply about harnessing these fundamental financial principles. Letting compound interest work its magic over long periods, keeping your investment costs incredibly low, and participating broadly in the growth of the economy.
And the path itself is remarkably simple, isn't it?
Deceptively simple. Start as early as you can, even if it's a small amount. Invest consistently, preferably automatically. Keep those fees rock bottom low by using index funds. And then, the hard part sometimes, just stay invested for the long haul. Through thick and thin.
You don't need to be a genius, you don't need luck, you don't need a huge income, just discipline and time.
And that leads to another key point, I think. The democratization of wealth building. That's what index funds really enabled. Before them, serious investing often felt like a club for the wealthy, requiring lots of capital or specialized knowledge or expensive advisors.
Right, it seemed inaccessible.
Index funds blew that wide open. Now, literally anyone, a teacher, a plumber, a student with just a few dollars and an internet connection can use the exact same powerful, low-cost market tracking strategy that, frankly, billionaires also use. It's leveled the playing field dramatically. It's creating a whole new generation of everyday millionaires.
That's a really powerful way to think about it. So maybe a final thought for everyone listening. What's the one thing they should take away and act on?
If I had to pick one thing, it would be this. The most impactful financial decision you might make isn't some complex trade. It's simply deciding to start investing in low-cost index funds consistently today.
Not next week, not next year.
Today. Today. Every single month you wait is a month of potential compound growth you lose forever. And over an investing lifetime, those lost months, those lost years, they can literally add up to hundreds of thousands of dollars in missed gains.
It's the cost of delay.
Exactly. The cost of delay is immense. So the provocative thought maybe is, make the decision today that your future self, your future potentially millionaire self, will thank you profoundly for.
Make that future self happy. Start now.
Make them happy. Start now.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.